Well, the investment implications are multifold. One, I think with respect to Canadian companies, one has to think about the demand for their goods and services that are exported from Canada to the United States and the implications thereof with effectively a 25% tax on those goods, how it changes the demand for their products, if there's any substitution, if they can reroute products globally that otherwise would have gone to the US. So the implications, first and foremost, on a primary basis, are on profits going forward. Secondarily, what misses a lot of people's radar screens is implications for the Canadian currency. So a weakening Canadian dollar, what that does for capex and capital expenditures that would otherwise be priced in US dollars. All that capex just all of a sudden became more expensive. And therefore, does it derail Canadian companies' future plans for spending? What are the implications for profits and cash flow predominantly on a go-forward basis for those companies under the auspices of a weaker Canadian dollar? I think the other thing one has to think about with respect to the tariffs is the duration thereof. So there's a lot we don't know today. And so when thinking about it, if this goes on for, say, 1 or 2 months, it has very different implications than if it were to go on for, say, 6 to 12 months. And the 6 to 12 month scenario would then dovetail into the overall health of the Canadian economy in the form of likely higher unemployment in a variety of industries and sectors. With that rise in unemployment, you would then have knock-on effects to the Canadian economy in companies or industries that otherwise wouldn't be directly affected by tariffs. So one has to think about even domestic consumer discretionary industries. One has to think about implication for banks and financial services and what that means. And then that all dovetails into central bank policy with respect to the Bank of Canada or any other fiscal measures that the Canadian government wants to undertake. So while we see the headlines and the obviously the sticker shock of 25% tariffs on Canadian exports going to the US, the implications will change based on the direction, the duration of these tariffs. So that's the other thing someone has to look out for going forward, which could change the investment implications. So today, portfolios will probably be doing a variety of things, toggling positions accordingly, but those positions may change in the future based on if there's a relaxation of those tariffs by the US government, if there is further kind of countermeasures imposed by the Canadian government, and most importantly, I think, really the duration that these tariffs affect us all, and that will have bigger knock-on effects as we go on throughout the year if there are no changes from what we know in the present. So those are what I think are the most salient investment implications kind of going forward, and those are the ones that we're working with here at Fidelity as kind of a base case and positioning portfolios accordingly.